Welcome back to the deep dive. Today is Saturday, February 7th, 2026. We are opening a file that I think a lot of people overlook because it feels, well, frankly, it feels boring on the surface. We are looking at Workday, ticker symbol WDAY.
It's the classic boring is beautiful thesis. Everyone is chasing the next shiny AI object, the next semiconductor breakthrough, the next quantum computing startup.
Right.
But meanwhile, sitting right there in the middle of the Fortune 500 is this massive engine that quietly runs the entire show.
Exactly. And to set the stage for this deep dive, we're treating this like an AI investment memo. We have a stack of reports here, financials from the fiscal year ending January 2026, analyst notes, historical data on the SaaS industry, and our mission is pretty specific. We need to answer a core question. Is Workday just a good, mature software company that's a safe place to park cash? Or is it an exceptional long-term compounder?
Because those are two very different things for an investor, right? One is a utility, like a power company. It pays a dividend, it doesn't crash, but it doesn't change your life.
Right. It's stable.
The other is a wealth-generating machine. And looking at the materials, there is a real tension here.
That's what jumped out at me immediately. On one side, you look at this company and you see a fortress. You have balance sheet that is absolutely rock solid. You have customer retention rates that are, frankly, absurd.
Yeah.
We're going to spend some time on that 98% number because it sounds fake.
It does. It sounds made up.
And you have a near monopoly on what we might call corporate culture software.
But flip the coin and you see the wolves at the door. You have Oracle, which is arguably more aggressive now than they have been in 20 years.
Oh, for sure.
You have a business model that is heavily reliant on global employment levels, which is a scary thing to be tethered to in an uncertain economy. And then you have this governance structure.
For dual-class shares.
It effectively tells investors, sit down, be quiet, and let the founders drive until 2032.
So is the growth story over? Or has the profitability phase just begun? That's what we need to figure out. And I think to really understand where Workday is today in 2026, we have to rewind. We have to understand the DNA of this company.
You have to.
Because the origin story here isn't just business, it's personal.
It is deeply personal. In the industry, we call this the revenge arc.
I love a good revenge story. It adds a human element to the software.
Yeah.
Take us back to 2005. What was the landscape?
Okay, so set the scene. The year is 2005. The main characters are Dave Duffield and Anil Bousri. Now, Duffield was already a legend in Silicon Valley.
Right, from PeopleSoft.
Exactly. He had founded a company called PeopleSoft. It was his baby. He built it into a massive enterprise software company, and crucially, people loved working there. It had a culture that was unheard of in the cutthroat 90s. Duffield was known as a nice guy in an industry of sharks.
And then the biggest shark of them all enters the stage.
Enter Larry Ellison and Oracle. They launched a hostile takeover of PeopleSoft. And we aren't talking about a friendly merger where everyone shakes hands and toasts with champagne.
No, this was brutal.
This is a brutal, drawn-out battle in the press and the courts. It got ugly. Oracle eventually won. They bought PeopleSoft, and Dave Duffield was heartbroken. He essentially watched his creation get swallowed up by a competitor he didn't respect culturally.
So most people in that situation, having just cashed out for a massive amount of money, would just take the check and retire to a private island. Right.
Most people would buy a yacht and disappear. I mean, he was already incredibly wealthy.
Yeah.
But almost immediately, Duffield and his strategy chief from PeopleSoft, Anil Bousri, decided, we're going to do it again, but we're going to do it better.
Yeah.
We're going to build it in a way that Oracle can't touch.
And this is where the big bet comes in, because looking back from 2026, cloud sounds obvious. Everything is cloud. But in 2005, if you were building enterprise software, what did that look like?
It was the dark ages. It was client server, on-premise. You were literally shipping trucks full of CD-ROMs to a company's basement.
Wow.
They would hire an IT team to install it on their own servers, and then hire an army of consultants to customize the code. Upgrading to a new version took 2 years and cost millions because you had to rewrite all your custom code. It was heavy, expensive, and slow.
And Duffield and Bousri looked at that status quo and said, no.
They said, we're going to build this new thing called cloud native. It's going to be SaaS, software as a service.
Which was a radical pitch to a Fortune 500 CIO in 2005. Hey, take all your employee data, your social security numbers, your salaries, your benefits info, and put it on our servers, not yours.
It was considered reckless.
Yeah.
CIOs were terrified. They cited security nightmares, latency issues, control issues. I mean, the whole idea of multi-tenancy where your data is on the same server as another company's data was just anathema to them.
So what was the selling point? How did they overcome that fear?
They bet that the user experience would win. The fact that everyone is on the same version of the software instantly with no painful upgrades. The fact that you could access it from a web browser anywhere in the world. They bet that convenience and a clean interface would eventually outweigh the security paranoia.
And they were right.
They were right. That decision to be born in the cloud while Oracle and SAP were still trying to protect their legacy on-premise businesses gave Workday a massive head start.
It's the classic innovator's dilemma. The incumbents couldn't pivot fast enough because they were making too much money on the old model.
Exactly. They couldn't cannibalize their own sales. Why sell a subscription for $1 million a year when you can sell a license for $10 million upfront plus another $5 million in consulting fees to install it?
So they were trapped by their own success.
Completely. It took Workday about 7 years to really prove it at scale, but by the time they IPO'd in 2012, the market got it. They valued the company at around $9.5 billion.
That IPO was the validation moment. That's when Wall Street said, okay, this cloud thing is real.
It gave them a war chest, about $637 million in cash from the IPO. And that money was crucial because it allowed them to fight the incumbents on sales and marketing. But here is where the story gets really interesting strategically.
Okay.
If they had just stayed an HR company, just PeopleSoft 2.0, they would have been successful, but they wouldn't be the giant they are today. They had to pivot.
This is what the notes refer to as pivot number 1, financials.
Right. They realized that if you own the employee data, the payroll, the benefits, who gets hired, who gets promoted, you are sitting right next door to the money.
You're right next to the general ledger.
You're right next to the general ledger. You're right next to procurement. You know how much people are being paid, so you're core to the company's biggest expense line. So they expanded from human capital management, or HCM, into financial management.
Why was that so critical? Was it just about selling another product?
It was about exploding their total addressable market, or PAM. Suddenly, they weren't just selling to the Chief Human Resources Officer, or the CHRO. They were selling to the CFO. And the CFO holds the purse strings.
That's who signs the really big checks.
That's the person you want to have on speed dial. If you can run the company's books, you become the operating system of the business, not just the directory of the people. It makes you stickier. It makes the contract value way higher.
But they didn't just build everything in-house, right? I'm looking at the timeline here, 2018, pivot number 2. This looks like another big move.
Yes, the acquisition of Adaptive Insights. This was a big check, $1.55 billion. And at the time, Wall Street was a little skeptical. They thought it was pricey.
What did Adaptive do that Workday couldn't? What was the missing piece?
Planning. Planning in the corporate world refers to the office of the CFO doing budgeting, forecasting, scenario modeling.
The what-if scenario.
Exactly. Before this, Workday could tell you what happened yesterday. That's a general ledger. Adaptive allowed them to help companies predict what will happen tomorrow. What if we open a new office in London? What if revenue drops 10%? What happens to our headcount plan? Our cash flow? That simulation capability locked them into the CFO's office even tighter.
That feels like a very deliberate move. They're moving from the HR tool to the business operating system. It's a system of record becoming a system of intelligence.
Precisely. And that brings us to the modern era. We're recording this in early 2026. The last 2 years, 2024 and 2025, have been defined by one massive narrative shift: AI.
And looking at their recent activity, they haven't been sitting on their hands.
No, they saw the AI disruption narrative coming, this idea that AI might replace traditional software interfaces. So they went on the offensive. They acquired HiredScore for about $530 million. They bought Paradox, which is an AI hiring assistant. They bought Peakon for employee engagement.
Explain the strategy there. Are they just buying buzzwords, or is there a real plan?
It's defensive and offensive. The defensive part is they are terrified of being used as a legacy database, just a dumb repository where data sits.
Right, a dumb pipe.
Exactly. The offensive part is they want to be the enterprise AI platform. The pitch now is, we don't just store your data. Our AI helps you recruit the best talent automatically. It helps you plan your budget with predictive models, and it keeps your employees from quitting by analyzing sentiment.
So they are layering intelligence on top of the plumbing. They own the pipes, and now they're selling the smart water that runs through them.
That's a great way to put it. The plumbing is the moat, but the intelligence is the growth. If they didn't do this, they risk becoming a commodity while some AI startup took all the value.
Okay, so that's the history. They started with the vendetta, bet the farm on the cloud, and then expanded strategically into finance and AI. A great story. But let's talk about the machine itself. How does this thing actually print money? Because when I look at Section 2 of our Night, the business model, the thing that stands out is the predictability.
It is a beautiful business model. It's about 95% subscription-based,
So recurring revenue, the holy grail.
highly recurring. But the number you really need to look at, the one that lets investors sleep at night, is the backlog.
Define that for us. What is the backlog?
The backlog represents money that customers have contractually committed to pay Workday, but Workday hasn't recognized as revenue yet because they deliver the service over time. Usually these are multi-year contracts, 3 to 5 years long.
So it's future revenue that's already signed, sealed, and delivered.
It's locked in. As of the third quarter of fiscal year 2026, Workday has a subscription backlog of $25.96 billion.
Nearly 26 billion.
$26 billion. And that is up 17% year over year.
So let's put that in perspective. If the global economy falls off a cliff tomorrow and they don't sign a single new customer for the next, say, 3 years,
They essentially have $26 billion locked in the vault that will slowly convert into revenue on the income statement quarter after quarter.
that's an incredible cushion.
It provides a massive cushion. It gives them visibility that almost no other industry has. A car company doesn't know how many cars it will sell next quarter. A retailer doesn't know how many shirts they'll sell. Workday knows exactly how much money is coming in.
But the reason that backlog is so secure brings us to what I think is the most important metric for this entire company. The notes call it the Hotel California metric.
You can check out anytime you like, but you can never leave. Their gross customer retention is roughly 98%.
98%. That is practically a rounding error from 100%. So effectively, nobody leaves.
Statistically, nobody leaves, and we need to unpack why that is. Because it's not just because they love the software, though satisfaction is generally high compared to the alternatives. It's because leaving is a nightmare.
Walk me through that. If I'm a CEO and I want to switch from Workday to Oracle, what does that look like?
It's akin to doing a heart transplant on a runner while they're running a marathon. Implementing Workday takes months, sometimes years, for a massive conglomerate. It costs millions of dollars in consulting fees from firms like Deloitte or Accenture. You have to integrate it with your bank, your health insurance providers, your tax authorities in 50 different countries. It touches every single employee's paycheck.
So if it goes wrong.
If your Zoom account goes down, it's annoying. You make a phone call. If Workday goes down, people don't get paid. The books don't close. You can't report earnings to Wall Street. The company effectively stops functioning.
It's mission-critical infrastructure.
The most mission-critical. Once a CIO signs that contract and goes through the pain of implementation, they're not going to switch to a competitor just to save 10% on the license fee. The risk of the switch failing is too high. The career risk for the CIO is too high.
You don't get fired for keeping Workday, but you might get fired for a botched migration to something else.
100%. The switching costs are astronomically high.
That is the definition of a moat. But growth isn't just about keeping people. It's about getting more money from them. And this is the land and expand strategy.
Right. And the metric here is net retention. It has been over 100% for more than 7 years.
Explain what that means. Over 100%.
It means that if you take the cohort of customers from 1 year, a year later, that same group is paying you more money than they did before, even after you account for the tiny 2% who leave. So even if they didn't sign a single new customer this year, their revenue would still grow because their existing customers are buying more.
The report says 60% of their growth comes from existing customers.
That is a staggering statistic. Think about the efficiency of that. They don't have to go out and spend huge marketing dollars to convince a stranger to trust them.
Right. The trust is already there.
They just go to their existing client who already trusts them and say, hey, you use us for HR, why don't you add the planning module, or the learning module, or talent optimization? The sales cycle is shorter, the cost of acquisition is lower.
It's farming versus hunting, and they are excellent farmers.
They are. But, to be fair, we have to point out a strategic weakness here. Workday is not for everyone. We call this the manufacturing gap.
Explain that. Where does Workday fail?
Workday does not do heavy supply chain management or manufacturing execution systems. If you are Boeing building jet engines or ExxonMobil running an oil refinery, you need complex supply chain software that tracks widgets, raw materials, shipping logistics down to the bolt.
That's SAP's home turf, right?
That is SAP and Oracle's world. They are very, very strong there.
Yeah.
Workday has effectively chosen not to compete on the factory floor.
So Workday is primarily for the service economy.
Exactly. Tech, finance, healthcare, education, government, the office economy. They have effectively conceded the factory floor to SAP and Oracle. This limits their market somewhat, but it also allows them to focus intensely on the industries that deal with people and services, which are arguably higher margin.
That's a crucial distinction for an investor. You aren't betting on the industrial sector here.
No, you are betting on human capital, on knowledge workers.
Okay, let's zoom out to the battlefield. We know what Workday is and why it's sticky, but what about the market size? Is there any room left to grow, or have they eaten the whole pie?
The pie is still getting bigger. The total addressable market is cited at over $100 billion. The HCM market alone is $60 billion plus, and Workday is currently doing about $8.5 billion in revenue.
So they have less than 10% of the theoretical market. There's runway.
There's a lot of runway.
So where does the growth come from? Is it just stealing more clients from Oracle?
That's part of it. But the big frontiers are international getting bigger in Europe and APAC and the mid-market.
Talk to me about the mid-market. That sounds harder.
It is much harder. When you sell to a Fortune 500 company, it's a massive deal, huge margins, and they stay forever. The mid-market companies with 33,000 employees is scrappier.
The deal sizes are smaller?
The deal sizes are smaller, so the margins are initially lower. You need a faster sales cycle. You can't spend 2 years whining and dining a company for a $100,000 contract. You need a more efficient sales motion.
So how is Workday attacking that? Because their DNA is enterprise. They are used to the Ritz-Carlton, not the Holiday Inn.
They're using what they call Workday Launch. It's a templated deployment. Instead of customizing everything, they say, here is the standard best practice version of Workday for a company in your industry. Take it off the shelf. It's faster. It's cheaper.
Like a prepackaged solution.
Exactly. It's working, but it's a volume game. It's a harder game than just hunting whales. They have to sell a lot more units to move the needle. And the competition down there is fiercer, too.
Let's talk about that competition. You mentioned Oracle earlier as the villain.
Yeah.
What is their strategy today?
Oracle is the arch nemesis. And under Safra Catz, they are incredibly disciplined and aggressive. Oracle's strategy is bundling. They go to a CEO and say, look, you already pay us for your databases. You pay us for your cloud infrastructure, OCI. If you use our ERP, our HR software, we'll give you a price you can't refuse.
They'll bundle it all together for a massive discount.
A massive discount. They'll practically give it to you for free just to get the logo and displace Workday.
That's a tough price to beat. Free is a very compelling price point.
It is. But Workday keeps winning marquee clients against them. They recently won the Department of Energy and Kelly Services.
Why? Why pay millions when Oracle is offering a discount?
User experience and architecture. Oracle grew by buying a bunch of different companies. PeopleSoft, J.D. Edwards, NetSuite, and mashing them together. It's often a Frankenstein of code.
I see. So the pieces don't always fit together perfectly.
Right. The data doesn't always flow smoothly between the pieces. You might have to log in to different screens. Workday calls their advantage the power of one. Single data model, single security model, single user interface.
So if I'm a user, Workday feels like one app. Oracle feels like 5 apps taped together.
That's the perception Workday sells, and frankly, it's often the reality. And for a CHRO who cares about employee experience, that matters more than bundling discounts. If the employees hate the software, they don't use it, and the data becomes garbage.
There's an interesting note here about the narrative versus reality. Workday calls itself an AI platform, but our source materials suggest the reality is they are the best in suite for service industries.
That's the sober analysis. The AI stuff is cool, and it's necessary to keep up. It's table stakes now. But the reason people buy them is because they are the best administrative suite for service companies. The AI is the sizzle. The suite is the steak.
Okay, let's move to the scoreboard. Because all of the strategy is great, but show me the money. And this is where the investment memo for 2026 really shifts gears. Section 4 is about the profitability pivot.
This is the single biggest change in the investment thesis over the last 3 years. If you looked at Workday in 2022 or 2023, they were running at a GAAP loss.
For the listeners, define GAAP loss in this context.
Generally accepted accounting principles. Basically, the real bottom line, including all costs like stock-based compensation. They were burning cash on paper to fuel growth, spending heavily on marketing, R&D, sales commissions.
It was the classic Silicon Valley growth at all costs model.
100%. And for a while, Wall Street loved that. But the mood changed.
And so did Workday.
They have crossed the valley of death. In the third quarter of fiscal year 2026, their GAAP operating margin hit 10.7%. That is a massive swing from negative 3.6% just a few years prior in FY 2023.
So they're officially properly profitable now.
Yes. And their non-GAAP margin, which is what a lot of analysts focus on, is approaching 30%. That's lucrative. That's elite software company territory.
And what does that signal to an investor?
It's the sign of a mature compounder. They're proving that the business model have operating leverage. That means as they add revenue, they don't have to add costs at the same rate. Sales and marketing expenses are declining as a percentage of revenue. The machine is becoming more efficient.
However, we have to address the elephant in the room. Every tech investor argues about this. Stock-based compensation, or SBC, it's a big number here.
It is huge. About $1.1 billion in just 9 months.
Break that down. Why is that bad for an investor?
Well, instead of paying employees cash, Workday pays them with stock options. This keeps cash in the bank, which looks good, but it creates new shares. If I issue stock to pay my employees, your slice of the pie as a shareholder gets smaller. It dilutes you.
So it's a non-cash expense, but it has a real cost to shareholders.
A very real cost. And it's a big reason why their GAAP profit is so much lower than their non-GAAP profit.
So how do they defend that? Because $1.1 billion is a lot of dilution.
Their defense, and it's a valid one, is the buyback. They are generating so much free cash flow, about $1.85 billion year to date, that they can turn around and use that cash to buy their own stock back from the market.
Okay, so they're mopping up the new shares they're issuing.
Exactly. In 1 quarter alone, they repurchased $803 million worth of stock.
So they're printing new shares to pay employees, but then using their cash profits to buy shares back, effectively neutralizing the dilution.
Correct. So as an investor, you shouldn't just look at the earnings. You should look at free cash flow per share. And that metric looks very strong. They are converting revenue into cash at a very high clip.
And the balance sheet.
Pristine. It's a fortress. They have a net cash position, $6.8 billion in cash versus about $3 billion in debt.
Which means they don't need Wall Street.
They don't. If a recession hits, they don't need to raise money. If a cool acquisition target pops up, they can write a check. That is financial independence.
That leads us perfectly to the people writing those checks. Section 5, the pilots. We talked about Duffield and Bousry founding the company, but who is flying the plane in 2026?
It's been an evolution. Anil Bousry has moved to executive chair. The new CEO is Carl Eschenbach.
He's the ex-Sequoia guy, right?
Ex-Sequoia, and before that, he was a key operator at VMware. He is a professional operator. He's not a founder visionary in the same way Duffield was.
So he was brought in to do what?
He was brought in to scale the business efficiently. Duffield and Bousry were the visionaries. Eschenbach is the executioner. He's there to make the trains run on time and hit the profit targets. And we saw his handiwork in January 2025.
The layoffs.
The layoffs. They cut about 8% of the staff. Now, for a company with a nice culture like Workday, Duffield's whole thing was happy employees, that was a shock.
It was a culture shock, for sure.
But the market loved it. It was a signal that the growth at all costs era was over. Eschenbach was saying, we are going to focus on AI, and we are going to cut the bloat.
It's discipline over bloat. But let's talk about the governance, because there is a catch here for investors. The notes call them benevolent dictators.
Workday has a dual-class share structure. Class B shares have 10 votes. Class A shares, the ones you and I can buy, have 1 vote.
And who holds the Class B shares?
Duffield and Bousry. They control about 67% of the voting power.
So basically, if they want to paint the headquarters pink, they paint it pink. If they want to merge with the taco truck, they merge with the taco truck. We can't stop them.
Oh, theoretically, yes. As a shareholder, you have no say. Investors are passengers.
That's a huge risk for some people.
It is. But to be fair, they have been excellent drivers. They built PeopleSoft, they built Workday, they have made shareholders a lot of money. And importantly, there is an expiration date. This structure sunsets in 2032.
Okay, so he has 6 more years of the dictatorship. But so far, the capital allocation, how they spend that cash, has been rated exemplary by Morningstar.
And that rating is earned. Look at their acquisitions. They don't do empire building. They don't buy random companies just to get bigger to stroke their egos.
No vanity projects.
None. They buy technology they need. They bought Adaptive for planning. They bought Peakon for listening to employees. They paid cash mostly so they didn't dilute shareholders. It's very disciplined. They treat the money like it's their own because with their share ownership, it is their own.
So everything sounds great. Sticky product, profitable, cash-rich, smart management. But this is the deep dive, and we have to put on our skeptical hats. What is the bear case? What breaks this machine?
There are 4 main risks that keep me up at night regarding Workday. The first is the headcount trap.
This is the macro sensitivity.
Yes. Workday's revenue model is often indexed to the number of employees their customers have. They charge per user per month. or based on employee bands. So if we hit a global recession and the Fortune 500 lays off 10% of their staff.
Workday's revenue automatically drops, even from their most loyal customer.
Exactly. They're indexed to global employment levels. We saw growth slow down during the tech layoffs of 2022-2023. It's a real vulnerability. But there's a bigger, scarier version of this risk.
The AI replacement theory.
Right. If AI actually leads to a world with fewer employees permanently, if companies can run with half the staff because of automation, Workday has a structural headwind. They are selling seats in a room that is getting smaller.
That's a scary thought. The AI Investment Memo is the title of this show, and usually we think AI boosts tech stocks. But if AI reduces human headcount, the HR software company might suffer.
It's the irony of the situation. They need to pivot their pricing model to be based on value or transactions, not just heads, if that future comes to pass.
Yeah.
If they can't pivot that pricing, their growth is capped by population growth.
What's risk number 2?
The good enough threat. We talked about Oracle being aggressive. What if Oracle Cloud becomes just good enough? If the quality gap shrinks, but the price difference remains huge, CFOs might force CHROs to switch. Hey, I know you love Workday's interface, but Oracle is half the price, and our margins are tight this year.
In a cost-cutting environment, good enough is a powerful competitor. The switching cost moat protects the existing base, but it might not help them win new deals.
Precisely. It could stall their growth.
Mm.
Which brings us to risk number 3, valuation. The stock is priced for growth. It's priced, assuming they will keep growing in the mid-teens, say 15% to 17% a year.
It's not a value stock.
Not at all. And if they hit a wall, say they fail in the mid-market or Europe slows down and growth drops to single digits like 5% or 8%, the stock price gets crushed.
The multiple compression?
Right. A company growing at 15% is a growth stock and gets a high multiple. A company growing at 5% is a utility. The valuation difference is massive.
Yeah.
You could lose 30–40% of the stock value just on that sentiment shift, even if the company is still profitable.
And the final risk. You mentioned 4.
Data security. It's the tail risk.
Right.
Low probability, high impact event. Workday holds the most sensitive data a company has. Social security numbers, salaries, bank accounts, home addresses, performance reviews.
If they have a massive breach.
It's not just a PR bad day. It destroys the brand promise. Their brand is safety. Their brand is trust. If they lose that, they lose the moat. Customers might not leave immediately because it's hard to switch, but new customers would stop signing up. It would be a catastrophic event for the business.
Okay, that's a heavy list. But let's try to synthesize this. We've looked at the history, the engine, the financials, and the risks. Let's do a recap of the key insights for the listeners.
I'd boil it down to 3 words. Sticky, profitable, durable.
Break them down.
1. Sticky. 98% retention is the number to remember. It's the anchor of the thesis. Customers effectively cannot leave. This provides a floor for the business.
Okay, number 2.
2. Profitable. The turn to GAAP profitability changes the profile from speculative tech to blue-chip quality. They are generating real cash that can be returned to shareholders through buybacks. It's a real business now, not just a growth story.
And the 3rd.
3. Durable. The backlog and the switching costs mean this company isn't going anywhere. It is a fortress. It's built to last through economic cycles.
So the final verdict, back to our original question, is Workday a good business or a great one?
I think the evidence points to great. It is a compounder. It's not going to double in a month like some hot crypto coin or a speculative AI startup.
Right, it's not that kind of play.
But it has the mechanics to generate wealth over a decade. It's the kind of stock you put in the portfolio and check on once a year. The business model is just that strong.
But with the caveat that we have to watch the mid-market success and Oracle's win rates, those are the canaries in the coal mine.
Absolutely. You have to verify the thesis. If retention drops to 95%, the thesis is broken. If their win rates against Oracle start to slide, you have to reevaluate.
I want to leave the listener with a provocative thought, something we touched on earlier. We are moving into an age of automation.
The question I would leave you with is this. In an AI world where companies might have fewer employees but higher output, how does Workday adapt? Can they become the operating system for the AI agents as well as the humans?
So you mean, can they charge a license fee for a bot?
Exactly. Because if they can charge for the digital workers the same way they charge for the human ones, the upside is infinite. If not, they're tied to a shrinking asset class. Human labor.
That is a little terrifying, but fascinating. Managing the digital workforce, that might be the deep dive for 2030.
I'll mark my calendar.
That's a wrap on the Workday File. Thanks for listening to the deep dive. We'll see you next time.